Hey, the technology
Hello,
word.
everybody. Happy Tuesday to you. Thank you for joining us again. And thank you to all the wonderful people that emailed me saying, do you have power? Do you have heat? For those that don't know, I'm in Rhode Island, and last week we got hit with the biggest snowstorm in 50 years. We had over 30 inches of snow at our house. It crippled everything about the state. My kids were out of school for a week.
That's crazy.
I know I've never heard of, and we're used to dealing with snow,
Yeah.
but I didn't have power or heat for about 36 hours. That was
Tell
challenging.
people how you stayed warm.
I couldn't leave by cuddling with my family. What else could I say?
Well, didn't you use the Tesla a little bit
Oh
too?
yeah, I use my Tesla to stay warm and to power my devices. I couldn't get out of my road because I'm on a cul-de-sac and they plowed us last. So I literally couldn't leave my house by car for 3 days. I had to borrow my neighbor's car to drive to the grocery store. So thank you for your patience. Thank you for your patience with us. We were going to do Palantir last week, but we are going to do them in 2 weeks' time instead for a special reason, and you will see why. But thank you for joining us today. You are in the right spot. Stoffel, what stock are we talking about today?
We're talking about Shopify. I will say, as a point of pride for myself, a stock that I first started owning at, I believe, $4 per share.
There you go. So every Wednesday, we ask our newsletter readers, what stock do you want us to research? Shopify beat out Datadog, UiPath, and Upstart. Zero interest in like Upstart, which was a bit surprising. Now, how hard of a stock to research is Shopify? Middle of the road, kind of. It's not that hard, not that easy. It's not as easy as a retailer and stuff. But we want to know. Let us know in the chat. Do you own Shopify? Are you a shareholder? Mr. Stoffel is a shareholder. I'm a shareholder in this stock, have been for at least 6 years. Now, it's been good to me. It's been great to you. You were in far earlier than I have.
Yeah, and I'm not alone. Olivier and Elizabeth Alvaro own it. Ari. Then we've got a bunch of people who don't own it too. I don't know. I'd say just based on this, I would say very small sample size. It looks like we're 3/4 yes owning it.
Cool. Great. Those that don't know me, my name is Brian Feraldi. I've been investing in stock market for about 20 years. There are my returns over the last 14 years or so. I'm the blue line.
And here are my returns. This was as of the end of the year. Last year, my results are in the green line. The S&P 500 is the red. The yellow is the NASDAQ composite.
And we are here to teach you how to research a stock from scratch using Shopify as an example. Now, we are going to be using Stock Simplifier to do this. If you've joined us before, we are actually stopping selling the version of Stock Simplifier that you are about to see us do.
We don't want you to buy it.
We don't want you to buy it as of today. We'll explain why at the end. But if you've been with us before, it's a 7-step process for analyzing a company, the phase it's in, the business, the growth, key metrics, valuation metrics, and more. So I'm going to open up a fresh copy of Stock Simplifier. It is the tool right here. I'm also going to open up our prompt database. I'm also going to get a fresh copy of Fiscal going. So here are the AI prompts that we are going to use. I'm going to make a fresh copy of Stock Simplifier to get that going.
Hey, Brian, and real quick before we get started, just so Tim and Bruce don't freak out, you still have access to Stock Simplifier, and you will. There's an advantage to it, which we'll talk about in a minute.
We're taking nothing away from you. Nothing away from you. But we have. Well, we'll let you know at the end of the live stream why we're not selling the version you're about to see anymore. And I'm pretty sure you'll appreciate why we're doing that. So anyway, with Shopify, the very first question that we want to answer about this company is, which phase of the business growth cycle is this company in? Is it startup, hypergrowth, self-funding, operating leverage, capital return, or decline? Let us know in the chat what phase you think Shopify is in. But while this is happening and we're getting those responses, I'm going to go to Stock Simplifier. I'm going to type in the ticker.
Here's what I'll say. We've got our first couple coming in now. People saying 4 or 5. I think I think the prompt will say 5 because I think that they've done buybacks, but to me it's a 4,
Okay.
which is exactly where everybody else is. They're saying 4 or a 5.
So I'm copying over the business phase analysis prompt. I have Gemini loaded. I'm going to load it here. It should say, what stock are we talking about? And I'm going to say Shopify. And let me zoom in on the results. And yeah, let's see what it says. Okay.
Yeah.
Shopify says it's a phase 5 capital return. It's highly confident in that. It has positive operating income. Yup. It's got strong revenue growth. Yes. And it has $2 billion in share repurchase authorization as of February of 2026. So it hasn't repurchased yet, but it has them authorized.
So I say 4, but I get why this says 5.
Well, let's double check since we're here. AI is very useful, but we're going to double check by clicking on financials, cash flow statement, and we're going to go back to buybacks, purchase
Down a little bit more.
Yeah,
there you go.
purchase
Net
common shares.
So $1 billion in repurchases.
Yeah. Okay.
Yeah.
So you think operating leverage though?
Yeah, just because for me it's about paying a dividend. Like you can be a stage 3 company and start repurchasing your shares if the time is right.
Okay.
That's me.
So if you said phase 5, you're not wrong. We're going to go with phase 4 just because we don't think the capital return is meaningful while they technically have one. This is where that nuance comes in, but we'll just say phase 4 from now. Now this matters because now the key metrics that we're going to use the valuation metrics we're going to use, those are all going to change based on...
I think they're more appropriate now.
Yeah, they're more appropriate. That is a good point. Okay, so we will go with that. So, okay, step 2. What does this company do? We want to learn how it makes money, its key products and services, who are its customers, where does it operate, and some qualitative factors about the company. So we have the business analysis prompt here. We're going to go to Gemini, paste, and we are going to start reading. And the good news is we both know this company fairly well, so we can tell how accurate this is.
I'm curious. There's a lot going on in the age of agentic AI. I'm curious how much it might capture here.
All right. Is that big enough?
Yep.
All right. So this is based on the annual report 10K for the year ending 2025. So Shopify provides essential internet infrastructure for commerce. It's an all-in-one platform that allows businesses of all sizes to start, run, and grow their stores. The platform enables merchants to sell products across multiple channels, including online, physical retail, and social media marketplaces. Fairly good explanation?
Yep. Great to be able to plug into one place and hit everything.
How does it make money? Shopify generates revenue for 2 places: merchant solutions and subscription.
It's my favorite part of the business.
Total revenue was $11.6 billion. So merchant solutions, this was 8.6. This is the primary success-based revenue from payment processing fees, referral fees, and advertising. As merchants sell more, Shopify earns more. That's well said.
By the way, I just want to say we've got a Shopify employee online here, so we're gonna go to our potato in Japan to ask him questions.
Good to know. See how well we really know the company. And then subscription, 26% of revenue. I remember at IPO, this was like the only revenue source.
Yeah, I mean the thing is that so subscription revenues are small, but the margins are much higher for subscription.
And it's highly predictable.
Yeah.
So this is recurring monthly or annual fees paid by merchants, includes basic, Shopify Advanced, and Shopify Plus for large organizations. Okay. Who are the customers? The company serves millions of merchants. These range from entrepreneurs making their first sale to global icons. Aldo, Estee Lauder, Mattel, and Skims are notable brands. Shopify saw significant growth in business-to-business merchants that grew 96%.
Transaction volume grew 96%.
Pretty good. Where does it operate? Shopify operates globally through North America, though North America remains its dominant market. 73% of revenue, 44% from the US specifically.
It is a Canadian company.
Europe, Middle East, and Africa, 16%, and Asia Pacific is 11% of revenue. Time for some qualitative factors.
Yeah,
how often do customers buy? Shopify has a highly recurring revenue model. Subscription fees are paid monthly or annually, providing a monthly recurring revenue, which is $205 million in monthly recurring revenue.
That's small. That's a small base, but that's the part that's high margin and guaranteed.
Yep. And it's every time a company makes a purchase. Can Shopify raise prices? Yes. Shopify demonstrates pricing power through direct plan increase and a take rate expansion. In 2025, the company maintained 30% revenue growth despite competitive pressures. More merchants are adopting higher margin services. Shopify Payments now processes 68% of total transaction volumes, up from 64%. So Shopify Payments are taking share on their own platform. Good.
Let me say something real quick about this too. This is magic because Shopify, I can't remember if it was a year or two ago, they said, we're raising the prices on our subscription plans. And for some of them, it was a significant increase. And not only did nobody leave, but they kept on growing the number of merchants without batting an eye. And the thing is, obviously they can't abuse that, but that is a huge gross profit driver that they can pull when they need to.
There you go. All right. What happens in a recession? Shopify's business is sensitive to consumer spending, which can fluctuate in a downturn. Management notes that tariffs and geopolitical landscape have forced merchants to adapt, often by moving more of their business to Shopify's efficient digital tools. Companies moved towards profitability by design. $1.5 billion operating income for 2025 provides a much larger cushion than it had in previous cycles. So I'm guessing that
I still think they would hurt in a downturn. They're big enough now. Like before, they were so small that no matter what, they could keep growing. But I think they would hurt it with a 2008 type deal.
Right. So, and the 2020
that
recession, I mean, it was a boost to companies like this, obviously. But they have had no problem growing after that fact. They've 4x'd since COVID, which is kind of bananas. And let's double check those key numbers. So subscription revenue 2.7 and 8.8. So Gemini got that right. US revenue was 7.3 billion. So US is closer to 60%. It said 40. EMEA is the second biggest. Europe, Middle East, and Africa is that. APAC and stuff like that. So it got those largely correct, but a couple off.
Now it is worth looking at this. Look at that gross profit there. Do you see subscriptions? They're that tiny part of revenue, but they're still 40% of gross profit. So they're 2.2 billion in gross profit for subscriptions, even though they're only like 10% of revenue.
Right. Yeah, good point. Okay. So we have that. So what do you guys think? Is this an attractive business? So red, I'm confused. Not a good business. Yellow looks okay. Green, very exciting business. How do you guys rate that? Let us know in the chat what you would say to that. And what would you say, Stoffel? Red, yellow, green?
I think it's green. And here's the big reason why, Brian, is that it is a combination of flat rate, monthly based, and usage based. And I think when you can combine those two things, that's very powerful and anti-fragile.
Totally.
And I'm not alone. It seems like literally everyone who's responded so far, my goodness, I don't know if I've ever seen. Oh, we got a 1. Janie, way to come through for us. I know Janie.
Well, at least they understands. Yeah. Hard pressed not to really like this business. Lots of very attractive things about it. Okay. Next question. Moat. Does Shopify have a moat? There are 5 sources of moats: network effects, switching costs, low cost production, intangibles, and counter positioning. There's a current moat state. Is it none, narrow, or wide? And the all important moat direction. Is it shrinking, stable, or widening? So would love to know from the chat, what would you guess is Shopify's primary moat source? If you had to pick one, primary. It could have multiple ones. Maybe you think it has several of them, but if we forced you to say, what do you think is this company's primary moat source? Would love to know what people say. While we're waiting for those answers to come in, I'm going to do the moat. I'm going to ask Gemini the same question and see what it says.
All right. We've got a couple coming in. I agree with what everybody has said so far.
There you go. Lots of switching costs. So moat analysis. Wide current moat. The moat direction is widening. So it's wide and widening. That's best case scenario.
Some people say network effects too.
This says network effect and switching costs. Shopify has established itself as the operating system for e-commerce, 14% share of U.S. e-commerce growth merchandising volume, and a massive ecosystem of 13,000 apps.
That's where some network effects come in.
High gravity for its 5.1 million merchants. Its dominance is underpinned by 30% revenue growth, massive scale, 10 consecutive quarters of double-digit free cash flow margins. So network effect, wide and widening. Shopify's moat is driven by powerful two-sided ecosystem. As more merchants join, it becomes lucrative for third-party developers to build apps. That in turn makes it more functional of merchants, creating a flywheel. The scale of the network is so large that the first choice for commerce-adjacent technology partners, OpenAI for ChatGPT commerce, chose Shopify. Good to know. Here's some supporting information. Great.
I agree. This
How about
isn't
this?
the big one to me.
87% utilize at least one application beyond the core platform functionality.
Now, what I will say is I think, just real quick, I think that's going to become even more important moving forward in the age of agentic AI, because the data that's gathered is going to be really important to things popping up on a question you might ask Gemini.
Next, switching costs. Present, wide, and they're stable. Once the merchant integrates their inventory, payments, shipping, and marketing, the friction to go to a competitor like BigCommerce, WooCommerce is extreme. This is especially true for Shopify Plus enterprise customers who often integrate complex back office workflows into the platform. MRR was up 15%. Merchant Solutions was up 70% of revenue. And Shopify's all-in-one platform provides essential internet infrastructure for commerce, helps retrain penetration merchant solutions. Okay.
Real quick, there's something new called the Universal Commerce Protocol or something like that, which is a standard way of listing things that it's supposed to become the protocol for agentic AI. And Shopify actually wrote this. It's for the whole industry, but they wrote it with Google. And that's going to be what's kind of used moving forward.
Right, writing the rules is a good thing if you're writing the rules. Yeah. Okay. Intangibles. It says present and stable. They're narrow. Shopify's brand is synonymous with modern e-commerce, allowing to capture 30% of the market. Its Shop Pay accelerates intangible assets that improve conversions by up to 50% versus guest checkout. Okay. 30% of the e-commerce platform, Shopify Pay. And Shopify Pay increases conversion rates. I will say anecdotally, Shopify is like one of the biggest advertisers on YouTube. And in my house, YouTube reigns supreme. Like Shopify has been a major Mr. Beast advertiser for a couple of years now. And they continue to renew that. So obviously that's working for them. So I would say the Shopify brand is quite strong, especially with, I'm going to start a new company. What do I go with? Like Shopify has got to be your first card. Low cost production. This says no. While they have immense scale, it does not fundamentally operate at a lower cost than its peers. Its R&D and sales and marketing are high. Why is that? Gross margin is low. Operating expenses are high. And the biggest risk is operating pressure. Do you agree with that?
I do. I don't see where there's low cost production is usually not a thing when it comes to software companies, right? Like, so I get it.
Okay.
Now this next one I think is actually quite important too.
Counter positioning. So it says narrow and stable. Shopify counter positions against closed marketplaces like Amazon. While Amazon forces merchants to give up their customer data and brand identity in exchange for traffic, Shopify provides the tools to have their own brand. Amazon cannot copy this model without cannibalizing its high margin third-party marketplace and control. So they have 28.8% share amongst the top 100 million high traffic websites. That's growing. Shopify shares. Yeah. So they are counter positioned against specifically Amazon. I don't know if Walmart offers this. Amazon is definitely a competitor.
Well, think about it this way. What is it? There's been 3 companies that have gone public that started on Shopify. Like I think Figs is one of them, for instance. So Figs, when you're starting a clothing brand for medical professionals, you could go on Amazon and reach hundreds of billions of people or hundreds of millions of people right away. but they chose not to so that they could own the category themselves.
Yep. So this to me is counter positioning is actually very important from their biggest rival
from above,
right? Actually from above, which is rare, I guess, at this size and scale that counter positioning would be there. So all right, red, yellow, green. What do you guys think? What would you guys rate their moat? No moat at all, or it's a weakening moat. Yellow, it's a narrow moat that looks stable. Or green, this is a moat that is not only wide, or it's also expanding rapidly. You're excited by this company's moat. Yes, big on Mr. Beast for sure. What are people saying?
Got greens rolling in, and I am very much in agreement.
Totally agree. The moat here is the real deal. Okay, next, long-term potential. Can this company continue to grow? Or really, what's the story behind why we should believe that this company can continue to grow? So there's two ways a company can grow: get new customers or get existing customers to spend more. Now, on fiscal, if you go to the overview page, we see that this company has grown 27% over the last 3 years on a revenue basis. Earnings have grown over that same time period, actually negative, but over the long term, earnings are growing quite fast. Over the next 2 years, Wall Street's expecting 25% revenue growth and 46% earnings growth. Long-term earnings growth is expected to be 40% per year. And that I take as a number that is typically 5 years. So 40% annualized earnings growth is what expected as this company continues to scale. So let's go ahead and take let's see if we can get the story for why we believe that that's going to happen.
I'm going to be very curious if all the things that I just talked about, which they talked about on their conference call at length, is going to come up here about the AI agentic future.
Okay. Marketing and sales. This is going to be strong. Operating expenses are very strong, reflecting continued discipline while maintaining full throttle growth. Okay.
New
distribution. What?
UCP. It's what I talked about.
Launched Universal Commerce Protocol to enable checkout inside AI, search, and chat tools, integrated with platforms like Temu and TikTok to meet buyers where they are. So what is this again?
So think about it. Like, for instance, I need a hotel to stay at when my family goes to New York City for spring break.
Yeah.
And instead of going to Kayak or booking now, I just go into Gemini and I tell them everything I'm looking for. And then it'll pop up 4 choices. Now, the crazy thing here is, and maybe bookings is not a great example, but the dynamics are that Shopify gets a cut that's even bigger from purchases that happen with AI agents, as opposed to if someone just landed on the website, because customers like myself looking for that hotel are 10 times more likely to buy that than if I just saw it on, say, booking.com.
Yeah.
The key with UCP is the way that a lot of merchants list what they have can be very ambiguous, like a crimson t-shirt versus a red t-shirt. And the UCP forces them to standardize it in a way that AI agents can use. As like Brandon says, they speak a different language inside the browsers than humans do. And yeah, Shopify is, they along with Google literally are defining what that language is.
Gotcha. Okay. So yesterday, I was looking for a new dog chew toy, like a dog, and I went to Gemini and I said, "This is what I want," and it came up with like 4 different choices. Basically. Right. So you're saying that the protocol is developed by Google, you said, and Shopify, and they're defining that for the AI.
Yeah. Exactly.
I wonder if they're going to favor Shopify as a preferred shopping platform.
I mean, the idea is that everyone can use it, but the bottom line is nobody knows this better than Shopify.
So what that means is they're positioning themselves very well for the transition away from search towards AI.
Extremely well.
Great. Okay. Geographic market expansion, green. International revenue grew 36%, faster than North America. Nearly half of new merchant additions come from outside North America. Acquisitions, They had no significant acquisitions. They made an acquisition a couple years ago and then they divested it, I'm pretty sure.
It was for fulfillment. Yep.
Yeah. Okay. How about getting new customers to spend more? Subscription revenue grew 17%. They're driven by higher price plan adoption. Gross margins declined slightly due to shift towards lower margin payments. New products, business to business gross merchandise volume grew 96%. Shopify Pay grew 62%. Point of sale grew 27%. Customer retention, 10 consecutive quarters of double-digit cash flow margins, and Shopify Plus now is account for 35% of monthly recurring revenue. So overall, international expansion is number one. Business to business and enterprise, including Shopify Plus, is number two. Offline is number three. AI agentic is early stage, but vital.
I think that's the biggest one personally.
Well, it's not going to be a needle mover, but I think it is important that they're setting themselves up for it.
I think it's going to be needle moving a lot faster than people think.
Well, there you go. And then acquisitions, not so much. All right, green, yellow, red. What do you guys think? Does Shopify have growth potential ahead? Red, not much. It's low or negative. Yellow, it's good. It's there. It's positive, but it's not great. Green is great. Very exciting growth potential, even from today.
So we've got mostly greens. We've got a yellow. We've got Christopher, who's super excited to be joining us for the first time live.
Welcome.
Ari, well positioned. I would say mostly greens.
Yeah, I'm gonna agree with that. Pretty good start, I'd say.
Not bad.
Pretty good start, I'd say. Okay, now it's time to take a look at some key metrics. So because this company is in phase 4, which we identified, the key metrics are revenue, operating margin, free cash flow margin, earnings versus estimates, and return on invested capital. Now, we do have a prompt that does this work for us. This is the most unreliable prompt that we have. AI really struggles with what we're asking it to do. So we'll look at the results and then we'll double check them manually to make sure we're in the right spot.
Oh, and it changed this to phase 5. Oh, because you know why? Because it's
right.
phase 5. It wasn't listening to us. I guess that we should feel good about this. Gemini is not listening to our conversation.
Thank you. I'm glad you caught that because I would not have caught that. There we go. Okay. All right. So phase 4. All right. So revenue growth, green, 27%.
We know that's true. You just checked it.
We do know that that's true. Operating margin, we want it to be positive and rising. So let's double check that. Financials. Operating margin is right here
there, yeah.
On the income statement. Yeah, so it bounces around, but the long-term trend is definitely positive more recently and rising. Was this because of the
I think it had to do with the divestiture.
Yeah, the divestiture. So hard to kind of see through that. In fact, if we look quarterly, where's the quarterly button? I bet you can see even more granulated. But yeah, this is positive
a little bit.
Yeah, this has been positive for a few years.
There you go.
Yeah,
that looks good to me.
The long-term trend is undeniably up and to the right. So it got that one. This is the annual number. But if you go quarterly, it's better. Okay, free cash flow margin, positive and rising. So we want to see that same thing. So for free cash flow margin, we're going to click out of that. We go to ratios. And then we go to margins. And then we look for free cash flow margin right there. I'm also going to do it quarterly.
This is actually wrong because they just reported it's now 20%.
It's 20%?
Yeah.
All right, so it looks like there's a cadence to this where is it Q4 is the best and then Q1
Oh, you know what? No, it was right. It was 20% for the fourth quarter.
Yeah, okay. So 19.5.
Yeah.
Yeah. All right. Long-term trend, it definitely positive and definitely rising. Earnings versus estimates. Let's see what they say. 5 of the last 8, but 4 of the last beat. So this is specifically earnings. So to get that, we go to estimates. We go to earnings per share. And then we look at the number quarterly. And we're looking for the A's for actual. So 51 cents estimate. Actual was 48, excuse me.
So they
And
missed
the
there.
estimate was 51. So this is a miss. This is a meet. This is a beat. This is a miss. This is a beat. So mixed track record there.
Yeah.
I'll go with that's generous. Got that so far. And finally, return on invested capital. So Gemini says green 21.6%. We just want this number to be above 5% and rising. So for this one, we go to financials.
Actually, I think you can go to the overview and it'll just show you too.
That's
Oh,
the
yeah, but it won't
5-year.
show you if it's rising.
That's
right.
the 5-year number. So we got to go to ratios. Close this down. And we go to capital efficiency. And it should be the first one if memory serves. Yeah. So this is annual. And if we go quarterly. So current number is 8%. And this number has been positive and it is definitely rising. Now, in a phase 4 company, a company that's still scaling, this number is not going to be fully fleshed out. No. So that's why we only demand for 5%. When it's phase 5, we want 20%. But the trend is it's definitely heading there. Overall, quite good. The most concerning number was the inconsistency of earnings versus estimates. But while we're here, I'm just going to check. This is a company that's still largely a revenue-driven number.
Yeah.
If we go to quarterly and just look at revenue. So again, we're looking at the A's for actual. So actual 3.7 billion, that's a beat. 2.8 billion, that's a beat. 2.7 billion, that's a beat. 2.4, that's a beat. And 2.8, that's a beat.
Yeah.
So revenue, the company has exceeded. We specifically call out earnings in this phase. So that to me makes it probably
that's where the nuance is, right?
Right. Yeah. I'm not concerned about them. I would rather, if I had to choose, I would rather them beat on revenue than beat on earnings.
Same.
You could pretty much say that for every company, in my opinion. I think revenue is more important than earnings.
Well, let's also point out that Shopify has significant investments in others that can affect its earnings.
Absolutely. That's a really good point. It's earning. You are totally right. The earnings are not nearly as important as revenue. Can you unpack that a little bit further?
Yeah, so Shopify has made an investment in a firm, and because of some GAAP accounting rules that happened about over a decade ago, in the past, if a firm's stock went up and down, it wouldn't affect earnings because it doesn't matter to the underlying business. But now, if a firm's stock goes up, Shopify's earnings per share goes way up, and if a firm's stock goes down, it goes way down. But that doesn't reflect what's happening at all. And look at how big those numbers are.
This is the number here that throws this earnings per share off. So, okay. So look at this. This is when a firm went public. Shopify said, we have a $3 billion gain, non-operating. So nothing to do with Shopify's business. The next year, a firm stock dropped like a rock. So we had a $3 billion loss and then a $1.4 billion gain and then an $800 million gain. And this year it's a negative $44 million loss. So because of this number here, because they own stock in a firm, that means that everything below this number is unreliable or outside of the company's control.
The business.
And look at what number is below here. Earnings per share. So Shopify is a bit of a nuanced case when, I would say operating profit, this number here, because it's above that non-operating income, this is the number that really shows the business growth for profits, not earnings per share. So sorry for the accounting deep dive there, but we think that nuance is really important for the company. We just did key metrics. Okay, great. Overall, looking really good.
Here's the big one.
Yep. Next, risks. Risks. So we define risks. Oops, keep going backwards. We think that all risk can be boiled down to one risk. That risk is execution risk. What are the reasoned probability that the company won't be able to deliver those expectations that are baked into the stock price? That to us is the real risk. Now, there are sub risks that need to be considered: concentration risk, disruption risk, outside forces risk, and competition risk. So let's go ahead and we have a risk analysis.
And I'm super interested because I have not done this one yet with Shopify, what it's going to say about AI. Yeah, because I mean, this is going to be really interesting because it's also grading itself.
So this says Shopify's overall risk is low. The primary risk is competition from Amazon/social and outside macro forces. With its asset-light free cash flow model and 1.5 billion operating income, mitigating that fact. Okay, concentration risk, not a problem at all. 5.1 million active stores. Totally agree. Concentration risk is not a problem, at least customer concentration. Disruption risk. So this says not an issue.
Yeah, but look at it. It does get drilled down into the important part.
Shopify is positioning itself as the infrastructure layer for agentic commerce. The UPC is co-developed with Google to enable native shopping inside agents like Gemini and ChatGPT. So good job, Gemini, finding that.
Yeah,
and revenue per employee has soared to $1 million after reducing headcount by 30%, while revenue continues to grow. So if you think AI is a risk, perhaps Shopify is more well insulated than most. Outside forces, yellow, high exposure to global consumer spending and discretionary income trends. International operations are subject to instability, inflation, and exchange. And agentic commerce shift creates a new dependency on search and AI policy partners like Google and OpenAI. So that could become a risk. The AI market share is still very much in flux right now.
Yeah.
So, in a couple of years, there might be that might be more solidified, but right now that's all up in the air.
I'm going to throw out that our friend here in Japan has survived 6 layoffs, rounds of layoffs at Shopify. So congratulations.
Yep. And then competition, yellow, severe competition from Amazon, TikTok Shop, and Temu are merchants for consumer attention. Shopify maintains 14% share and gross margin compression due to success and higher mix of lower margin companies. So green, yellow, yellow. What do you guys think? Is this a high risk business? Is this a medium risk business? Or is this a low risk business when you factor everything in together?
I will just say that I think the biggest thing is they've gotten to be so big that they are tied to the global consumer spending. Yep. And so I don't think that can be overlooked.
Yeah. Once you get to a certain size and scale, your growth becomes outside of your control because you're growing with the market effectively. But what are people saying?
The dominant one is yellow, medium.
Yeah, I would agree with that. Yellow trending towards green. I don't think this is yellow trending towards red. I think it's yellow trending towards green. The business itself looks quite solid. And it's worth pointing out, they're founder-led and they have a great history of executing well. That to me mitigates things quite well.
And to their benefit, cutting ties with previous forays into different areas that is painful to do, but it's necessary, like their fulfillment.
All right. So valuation, the primary ones we're going to look at forward price to earnings. We already know that one has problems because of the Affirm thing we mentioned before. Price to free cash flow, that's probably going to be the best one to look at. Although, to be fair, valuing Shopify is hard.
It's not easy.
Okay, so we're going to look at ratios. We're going to compress all the trailing ones. We're looking at forward ones. This is using estimates in the future. So let's start with PE. Is this meaningful? All right, you can see how all over the map this number is. Earnings per share, we'll take that out. And PE
64, I think, is where it is right now.
Gotta really compress that.
I mean, one thing I will say is that the forward estimates don't include Affirm and such. So that's one nice thing.
Okay. All right. So if we click this button here, we can put a medium and a high and a low in there. So, okay. So this company usually trades at about 72 times forward earnings, currently 64, as low as 40.
No one's calling that cheap.
Nope. That is not cheap in absolute terms. By contrast, the S&P 500 is 22-ish.
I think it's a little bit higher now, but
23, 22 to 25-ish. So about 2 to 3 times as expensive as the S&P 500. Okay, let's hide that one for now, and let's do the price to free cash flow. And we'll pull that one up. Come on, click.
There we go.
There we go. Okay. Price to free cash flow. So we got a big, huge thing here to kind of wipe out. So let's go ahead and move this forward to neutralize that thing. 60 times forward free cash flow. Average is about 70. Low is 44. High is 11. You know, since we're here, Stoffel, we might as well do price to sales as well.
Sure. You can pull that all the way back too.
Yeah, price to sales will be more meaningful number because again, it's just off of revenue, so we can get a sense. Now, Shopify has a gross margin in the 40s, something like that. Right. So, okay, let's see. This company got up to 47 times sales in the COVID bubble, and it collapsed down to 5 times sales. That's a 90% valuation compression. Currently 10.6. If we kind of go post-COVID, though, that's probably when it's most meaningful.
There you go.
I would even say a little bit further up.
There you go.
This is over the last 5 years. So the average is about 10 times sales, low of 5, high of 17, currently about 10. Green, yellow, red. What do you guys think? Red, the stock is overvalued today. Yellow, it looks fairly valued today. Green, it looks cheap compared to its historic norms. Would love to know what people think about the valuation today.
What do you think, Brian? I'm curious what your take is.
I would rate the forward price to PE, again, assuming it does not include those Affirm stock things, throwing that off, which makes sense to me. If you're estimating, you're just going to assume that that's not a thing. I would say fair there. And I would also say fair on a price to free cash flow basis. If you ask me on price to sales, I would also say fair. I mean, we have a pretty wide band of 20% within median. Even though the stock is down 30%, I would not rate this stock as cheap by any measures. It doesn't deserve to be cheap. I mean, look how well it did on everything else. Premium stocks like this do trade at a premium, and it hasn't got caught as much in the AI carnage as a lot of other companies have. So I would say, if you forced me to choose, I would say yellow. You?
Yeah, that'd be where I am. And it's worth noting that we know this from their decisions about layoffs, that they are focused on optimizing. Our friend says that during that pandemic peak, John Legend came and gave a private concert for all the Shopify folks. But these days, it's all about free cash flow optimization.
There you go. All right, we are at the end here, but we do have another prompt to run, the sentiment analysis prompt. This kind of takes a look at, well, what's the sentiment on Wall Street right now? And if we take this and we run this, we'll see, what does the media think? What do analysts think? What do retail traders like us think about this company over the last year? Okay. Following a relentless climb in late 2015 that peaked at 180, the stock entered a valuation breather. The company reported 30% revenue growth and $2 billion in free cash flow, but a cautious margin outlook caused the pullback year to date. The next catalyst is expected in May, and investors look for proof that its agentic commerce tools are converting into tangible revenue.
Yep.
Over the next 12 months, the outlook is neutral. So analysts are bullish, investors medium, media mixed, and Truist upgraded it to buy. It has a $2 billion buyback authorization. The bulls say agentic commerce leadership. That is important if you're a believer in this story there. The bears say the valuation is still high. The guidance was softened, low to mid-teens, a step down from 19%, and it still has macro sensitivity. So that is what matters there. Cool. Good to see that. So would love to know what people think here. Are you interested in Shopify's stock at today's level? Green. Yes, definitely want to own this stock. Buy it today. Yellow, kind of. I'll put it on my watch list. I want a better entry price. Love the business, but don't love the price. Red, nope, not interested in this stock at all. Perhaps too risky, perhaps too rich for your blood. You would have to have a huge discount today before you'd be interested in this stock. What do people think about overall about the business?
What I've got is, I mean, it's kind of all over the place. We've got a couple no's and reds. We've got some yellows, not till cheaper, and then we do have some greens as well. If I had to average this, I would say yellow is the average. I don't think that anybody has a problem with the company.
Yep.
I think people have a problem with the valuation, which is totally fair.
Sensational company, sensational leadership, strong kind of position. I love how they're positioning themselves with the AI onslaught. I think that does matter from a narrative perspective to appeasing Wall Street. Like, there's no doubt that that's actually a far bigger deal than I would say it had been in years past. I don't think it's a screaming buy today. I think you'll do fine if you're a long-term shareholder like I am, like I know you are, but I would not be foaming at the mouth to add to my position today.
I will say the two big things for me are, if there's a slowdown, like a global consumer slowdown, Shopify is going to get hurt. If they prove that the agentic AI is real, it could really take off.
I totally agree with you. Yep. I totally agree.
I mean, it could really, you could see 200 quick.
Yep. So, okay, Brian, so why don't we let people know, why don't we want them to buy Stock Simplifier?
Yeah, why are we trying to sell this?
Yeah, so we're going to be a little cagey here, but for the last couple of months, we have been working on a major overhaul to Stock Simplifier. It's not ready for us to unveil as of yet. We will give you a sneak peek of what we've been working on. Let's just say that for the last year, I have everyone that buys Stock Simplifier, they get invited to a one-on-one call with me to chat with me. And everyone that jumps on that call, I say, what do you like? What do you not like? How could it be improved? And for the last essentially year, we've been documenting things that people don't like and things that people do like. And I think we have an update coming that is going to really fix all of the concerns that we've gotten about the current version of Stock Simplifier. So to give you a sneak peek of what this thing looks like, here's what the current thing is going to look like. There is no more copying and pasting prompts. There is the ability to save your work. There's the ability to return to your work. Tons of good things are coming your way. So it's in beta mode right now. It is not yet ready to be unveiled or for people to purchase. We are working on all the back office stuff right now, but we've shown it to some people in our premium communities, and so far the feedback has been fantastic. So, yeah.
I'll put it to you this way. So Feroldi has been building this for months, and he wouldn't show it to me until this last Friday. This last Friday was the first time I got a chance to do it. I immediately took my computer and I showed it to my wife, and I drove over to my parents, and I had my dad play with it to see what he thought of it. And Brian, I am very picky when it comes to using tools. So
yeah, I know. Yeah. We think it's going to, the goal of the overall mission of the tool is to make stock research easy. Yeah. I think the current version of Stock Simplifier is fantastic. It is way more structured than most people do with their stock research, but it's not easy because there's copying and pasting and clicking, and there's a course that goes along with it. There's no leaving the tool. There's no need to leave the tool in the next version that we have coming. So more details to come. If you're on our newsletter, we're definitely going to let you know about that. And we do plan on doing a staged rollout, including we're going to have a wait list for people that want to get kind of like early access to it. But we are still weeks away from this being ready.
And if you have already purchased Stock Simplifier in the version you just saw us do today, we will be reaching out to you specifically, correct?
Yeah. Yes. Mercy just asked if I bought Stock Simplifier in the past, will I get it as well? We're changing some things about that, but let's just say existing Stock Simplifier purchasers are going to be first in line and get the best deal.
Yep. There you go.
So sorry to tease you like that. I thought it'd be fun.
Yeah, we got to show what we've got. We can't.
Our plan as of today is in 2 weeks. 2 weeks from today, we're going to do the deep dive on Palantir that we were supposed to do last week. We're going to do that. And our hope is that we'll be able to use the new stock simplifier to kind of show off how it works. I don't know if it'll be ready in time, but that's roughly what we are thinking. It will not be ready for purchase until a couple weeks after that, but we've got lots of back office stuff to do. But I know people are going to love it.
I used it. So look, if I use it, then I think it's going to do great.
Yeah. Well, where can past Tuesday live sessions be found? On my YouTube channel or on Stoffel's YouTube channel. If you click over to the live tab, everything that we've done there previously has been there. Well, thank you guys so much for joining us. If you're on our newsletter, we're going to show 4 stocks tomorrow for you guys to vote on for us to do next week. And then join us 2 weeks from now, where we hope to unveil the new stock simplifier and show you all the details that are built in. So I think you're going to really like that. Well, thank you guys so much for joining us today. We hope to see you guys next week. Happy investing.
Bye, everyone.